Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Daoud, and alongside Jason Burak. And today's podcast, we're not going to do an interview with a guest. Today, we're going to answer our listeners' questions that we got from the YouTube video that Jason did a couple of weeks ago. We had a bunch of questions, so we're going to take our time to answer them for our audience. So let's start off with the first question, Jason.
Sure, Mo. Our first question comes from Joe O'Malley. Would it be smart to use a credit card to buy a few ounces of gold? And, obviously, before I answer this question, and first of all, this is not financial advice, this is just my opinion. I will play Susie Orman, though. She plays that game for personal finance people, for people who are, I guess, beginners. Can I afford it? I guess that game's really popular among regular people who aren't as financially savvy. But I asked Joe what his, monthly annual income was, how much free cash flow his household was generating. So he said, and Joe, what I would say, in my opinion, if I were in your shoes, is if you really want more gold, since you own a lot of silver already, you want to diversify your precious metals portfolio, I wouldn't buy all my gold at once. So what I would do, if you want to use a credit card, and this is just to be smart with general debt in general, because you don't know what's going to happen to markets or people's incomes and things like that. Things can fluctuate. I would just buy, one gold coin, one ounce gold coin on a credit card if your cash flow can afford that, and then pay it off. And then, 1 month, and then the next month, buy one gold coin on a credit card and pay it off until you have a few things that way. And this way, you're using debt very carefully. I read Rich Dad, Poor Dad books, and obviously Robert Kiyosaki is controversial because, the stories aren't fully true. He basically made it up, but I still think you can learn useful things from them, useful financial education from them. And one of the main things I learned there is to be very careful with debt. He repeats it all the time. Debt's like a loaded gun. What's your cash flow? What are you using the debt for? Are you using it to buy cash flowing assets? Are you using it for consumption products? Can you easily pay the debt off? Are you drastically over leveraging yourself and things like that? So in your case, Joe, if I was you, if I was in your shoes, I think if I was going to buy gold on a credit card, I would definitely not max out my credit card and buy as much gold as I could. I would be very prudent with it, and maybe just buy one gold coin a month until I have the amount of ones I wanted. What do you think about that, Mo?
Yeah, that's great advice. Now, we don't know what kind of credit card he's using. He may have one of those credit cards where there's 0% interest for the first 24 months or whatever. If that's the case, then if you can afford it within your income, don't know exactly what your income level is, maybe you could buy a few ounces just as long as you make a plan to pay it off before your interest rate start to kick in. So that's another idea for Joe.
Okay, well, I think we answered that question well, but in general, I think people have to be very careful with debt nowadays, especially when people could lose their jobs very quickly out of the blue, and income can drop. You don't want to be saddled with $10,000 in credit card debt, and your income drops. So just be very careful with debt out there for everyone in our audience. Even if you get a teaser rate on a credit card or something like that, like Mo said, you still want to be very careful with your debt load relative to your free cash flow in your household and things like that.
Yeah, credit card can be a cancer to your financial budget, so people should be careful with that. So we answered that question for Joe, so let's go to our next question. Question is from Michael. Its question is, what are the causes and effect of the super cycle? And when he's talking about super cycle, he's talking about the commodity and stock super cycle.
Okay, well, first of all, I wouldn't exactly call what we've had a equity super cycle here for the most part. I mean, we've had a lot of busts in the last couple decades, Mo. I mean, we had the 1987 crash, and then not too much longer after that, we had the technology bubble, and then we had the 2007 and 2008 bust, and, the subsequent QE in 2009 that put it up. A lot of these things are based off, there's some fundamentals in there sometimes, with, especially in the case of the technology bubble, where you had legitimate technologies that were transformative, but you had, Wall Street hypesters who were trying to make extra money. You had venture capitalists who had made poor investments, and they were trying to take the stock IPO and dump it on the public at a high valuation. So, but I think a lot of this goes back, and in a lot of cases, Wall Street is doing the marketing for a lot of these equity busts. And a lot of this goes, and this goes back to the housing bubble too. Wall Street was making these new types of mortgage-backed securities and synthetic CDOs, which are collateralized debt obligations and collateralized mortgage obligations and credit default swaps and all these types of derivatives. And, these guys expected that if they made bad bets, they expected to be bailed out by the Federal Reserve. And, this goes the same way for Japan in the past. When Japan had a bust, their banks in the late 80s, early 90s, their banks didn't go bust. Their banks are zombie banks because the Bank of Japan and the Japanese government have kept them alive. So, this condones bad behavior. There's bad incentives in the marketplace, Mo, because of central banks. What do you think about that?
I agree. I mean, since the rise of the central bank, we're seeing more and more boom and bust. It's happening more and more frequently, too. I talk about the 1987 crash, and then almost 13 years later, the tech bubble crash. And then 8 years later, we had the housing bubble crash.
Fast and Furious, the bubble years.
Yeah. and I think like we're, 7 years later, we're due for another type of bust. And we have a lot of super cycles going on right now. We have the bond bubble. We have college debt bubble. We have the stock market bubble. And in some areas of the United States, we have the housing bubble that's been popped up. So thanks to central planning, there's a lot of super cycles. And because of central planning, we're seeing a lot of misallocation of capital going to the wrong areas of the economy, which caused all these bubbles to form.
Exactly. And the other super cycle Michael wanted us to comment on was the commodity super cycle. Now, there was legitimate fundamental reasons for this. You have China joining the WTO, or World Trade Organization, and after 1971, I believe, Richard Nixon went over there, and China decided that full communism had basically failed. And, they couldn't feed their people. I believe 30 million people were dying per year from food shortages. So, there was barely rice, and people had, I think almost everyone has heard the stories about how bad Chinese communism was. People were living on dirt floors, no electricity. Everyone had bicycles. People had, one or two shirts. Kevin Kerr, who's my friend, Kevin Kerr, he's been a past podcast guest. He told me he went over there to communist China, and he said that people used to, for job interviews or things like that, they used to borrow each other's clothes. They used to literally, take off their, like if they were sharing a house or something, roommates, they used to borrow each other's clothes to go out because they couldn't afford, their own clothes and things like that. So once China started, deciding to open up their economy more and allow investment into their economy, that's when you start to see the factories move over there. China decided that they were going to go to more of a capitalist, obviously not full free markets, because they still have a lot of central planning there. Look at all of the infrastructure projects and housing stuff, buildings that they built, and so many other things that they built. But once that started, the real explosion, the commodity supercycle increased, and a lot of the other emerging markets, their now share of the GDP a couple decades ago was a lot lower. It wasn't even a half for most of the rest of the world outside the U.S., Europe, and Japan. And now I think, Mo, the rest of the developing world, when you take out the U.S. and Europe, I think the rest of the world makes up about 65% of global GDP. So now, obviously, that was probably a couple years ago before commodity prices started to drop, but there was legitimate fundamental reasons for the emerging markets, the BRICS, China, that they have an emerging middle class. Now, obviously, their middle class is not the same as our middle class here in the United States. The middle class in China is not earning $40, $50, $60, $70,000 a year in their household, but they do have increasing wages. They are doing savings. They are consuming more goods and things like that. They're eating more protein in their diet, whereas in the past they ate a lot of rice and vegetables. Now they're eating a lot more protein, and they're starting to buy iPhones and nice new Mercedes and BMWs and things like that. So we're starting to see more consumption of commodities. And as Rick Rule says, who we're going to interview soon, he says one of the marks of the rising middle class in any country is that you start to see them buy more real commodities, more stuff. So whether that's a blender or more steaks or protein or more gasoline in their car to drive, those are or air conditioning in their house and things like that.
And also for a lot of these commodities, they're getting harder to replace their reserve for like oil, gold, and silver. Like a lot of for the oil market, 50 years ago, you could just poke a hole in the land and oil would be gushing out. Now they have to start. They're moving out to offshore drilling, and now we have frac drilling or horizontal drilling in the Balkans. And also for gold and silver, the supply is getting tight there, where the break-even price for miners to make money has to be for gold $1,200, and for silver it has to be at least $20. So, kicking in all that factor, the commodity prices had to go up.
Exactly, Mo. There was a massive increase in demand if you go back 15, 20 years from what demand is even at these levels, in a declining global economy, definitely a drastically declining global economy. But these numbers right now are still a lot higher than they were. And you did bring up the commodity producers' costs. I mean, to meet rising demand, they had to bring on more marginal supply. We've seen the grades fall in gold, silver, copper drastically in the last couple decades. They've fallen just enormously drastically. We went to use an example with silver. We've pulled, I think about 8 years ago, 10 years ago, we were only producing about 400, 500 ounces of silver. I think that's what David Morgan said in his first book, Get the Skinny on Silver. And we've gone up to over 700 million ounces a year of silver that we're producing now, Mo. The grades on those things have declined, and they need a much higher price to become economic. So you add that up with real supply and demand fundamentals, increasing a growing middle class in most of the emerging markets. You have oil producers like OPEC and the Saudis consuming more of their own production than they did in the past. And then you add in central planning from China, and that's why you had the commodity super cycle. Now, unfortunately, a lot of these commodity producing countries, and we'll talk about this more in the inflation deflation debate because this fits in there, but a lot of these commodity currencies, which are countries that produce a lot of commodities like Canada, Australia, Norway, Brazil, and emerging markets, they took on way too much debt to leverage up their economy and start exporting to China. So they believed in the China miracle. It had worked. They had made a lot of money off, selling new products and services and commodities into China for over a decade. And, now that China's slowing down, they still have the debt. And yet, their asset prices have fallen. Their cash flow has fallen. So this is the problem with using debt to grow your business.
I completely agree. So that's pretty much answered that question about the super cycle. So let's move on to the next question. So next question, this guy didn't have a name on YouTube, but his question was, what would be the best way to transport and secure gold and silver bullion internationally? Also, are offshore accounts really safe? So we did research on that question, and our friend Andrew Henderson from Nomad Capitalist wrote an article about the 5 safest countries to bank offshore. And his top 5 were Canada, Australia, Netherlands, Singapore, and number 1 is Germany. So Switzerland and the Cayman Islands not even on the list. So if you want to open up an account offshore, those 5 countries have safe banks where you can store your money. And the minimum amount required is not even that much. A lot of the banks offshore require at least $3,000 to $5,000 to open up a bank account. So I'll post a link to that article underneath this video for the people. And also the Magazine Global Finance, every year they post the 50 safest bank in the world. And number 1 is a bank in Germany. I'm not going to try to pronounce this bank, but they have the number 1 bank is in Germany. But most of the banks in the top 10 are from Andrew's list, which is Germany, Canada, Netherlands, and Singapore. So check out those countries if you want to open up an offshore account.
Now, I don't know if he means fully offshore for bullion. He might have meant also offshore for bullion. But you're talking about Big Dome on 31. That's his question?
Yes.
He also wants to know the best way to transport and secure gold and silver bullion internationally. Now, as of right now, you can take your gold and silver bars and coins. You can take them to a custom jeweler if you want in the United States, and you could wear them out. I've heard people doing that before, and they've gotten away with it so far. You can wear them out to another country, and you can put them in a foreign post office box that you can open, because a foreign post office box is not PO box is not the same as a foreign bank account, or safety deposit box. Safety deposit box. Foreign safety deposit box is not the same as a foreign bank account. The other stuff I would talk about for gold and silver and storing them internationally, I took a look at some of the bullion dealers, and I'll let you know about my thoughts on them. Gold Switzerland, which is Ian von Greyer's one, he's really the high end of the market for storage. He has, fully allocated, fully segregated. You can get, if you're institutional level clients, so we're talking probably 8 figures worth of storage. Unfortunately, he doesn't say it on his website, his storage fees. So you would have to talk to him and see how much he charges for storage and what the minimum is. But he has storage options in Zurich Airport, deep in the Swiss mountain. That's like the crazy James Bond vault there, but that's for institutional clients only. So you're probably looking at least 8 or 9 figures to store your gold there, and the management and the storage fees are going to be quite large. And, supposedly business is booming with him. Probably a lot of the Wall Street guys who bash gold publicly on TV and are short, they're probably buying gold and moving it over there. In Singapore Freeport and in Hong Kong International Airport, unfortunately, he doesn't have the prices listed, but contact goldswitzerland.com. Egon von Greyerz is well known in the gold community. Another one I looked at is Miles Franklin, which is a well-known bullion dealer here in the United States. They talk about having low storage fees, but they don't list them on their website. So I guess you'll have to call customer service. I do not see it on their website, but they perform audits, and it's allocated, and you can store it in multiple countries. Let's see here. There's one in Canada, and let's see here. I think there's a couple other different countries as well, or at least they were planning on opening them up in the near future. The ones I looked at, Mo, that have the best prices so far out of the ones I looked at, BitGold has storage available in multiple countries, and they offer, but you can only buy gold. So you can store your BitGold, physical gold, in multiple countries. I think there's 5 or 6 vaults to choose from, and you can take it back for delivery, and the storage fees are, I think they're 0 actually. And you only get charged for buying the gold. I think the storage is free because they keep all the gold in the same place, which, for a lot of other dealers, they can't really match that, but you can't store any silver with BitGold. And the other one I looked at that's really good, that looks good, is Sprott Money, which is Eric Sprott's precious metal dealer. And they charge some of the lowest fees in the industry, at least they claim to, but I mean every website was pretty much claiming that. They said the yearly minimum storage fee is $200 plus tax. Minimum monthly fee is $16.67 plus tax. And let's see what you're allowed to do. And I think you're allowed to take immediate delivery of the metal, and you're allowed to move it, I think, for a small charge from one vault to another. And they have vaults, 2 vaults in Canada, 1 in Delaware in the United States, 1 in Singapore, 1 in Switzerland, and 1 in the Cayman Islands.
And this is one of the disadvantages of buying gold and silver, that if you want to move it outside the border, it becomes somewhat of a hassle. So people that want to buy gold and silver now and want to save it or keep it out of the country, they should plan ahead rather than buy it now and then try to do something with it later. So that's pretty much answered the question for that listener. So let's move on to our next question. And this question is a question about China from Noodles Doctor. His question is, what is your opinion on China lowballing its gold reserves? Some have said that they many steps ahead of the West, and they're playing with their card firmly to their chest. But when they blow through $93.9 billion in U.S. Treasury just to prop up the yuan, are they just bad at handling their money and economy at the West?
Well, they are misallocating capital then, clearly, because they've done central planning and they have, 90,000 seat soccer stadiums that only 10,000 people are in. So obviously they've had misallocation of capital there because they've built enormous infrastructure projects and other fixed assets on a scale really never before seen in world history as quickly as they've done it. And there's a lot of Keynesians there too in their Bank of China who are PhD economists trained in London and in the United States who are making bad central planning. Now, with that being said, I do know that for a fact because I've spoken with the GATA people, the Gold Antitrust Action Committee. So the China sovereign wealth funds do know that gold and silver are manipulated. They've had multiple conference calls with GATA in the past about this. What I would say is there's really no benefit right now to them being honest about their total amount of gold reserves. It's just not in their interest to do it. There's some interesting theories out there. A couple of my friends, Lewis from Small Gold, SMAULGLD, who I speak with, I think he has a very good gold and silver website. A lot of people don't know about it yet, but they should. It might be, the next type of Kuz Jansen. I think he does a great job there. He used to work on Wall Street for a while, and he was a derivatives attorney. He has a interesting background. He's read a lot of Austrian School economics. And anyways, though, his theory is that China intentionally lowballed on a technicality because they have bought massive amounts of gold, way over 10,000 tons of gold, maybe even over 20,000, but that they stuff it into their sovereign wealth funds. They stuff it in 10 or 12 other places throughout China in major cities, and they give large amounts of it to their large state-owned, centrally run banks. And also, in other military locations and things like that. So he said the People's Bank of China may only have that much at the storage, but China may have, 5, 10, 15 other vaults that are very large throughout all of China storing gold. So they might have only given the exact amount of gold for one vault. But what we do see what we do see China doing now, Mo, is they're copying Russia, and they are announcing each month now that they're buying more physical gold in the market.
Yeah, and I interviewed Dan Collin, who lives in China. He thinks that they're lowballing their gold reserve so they can continue to buy more at a low price. If they were honest, it could spike the price and it'd be more expensive for them to buy it. And China reported their gold reserve at around 2,000 tons. But a lot of gold experts think they have way more than that.
They reported. Sorry to interrupt you, Mo. To be a little bit more accurate, they report around 1,600 tons, which was increased from their last announcement, which was around 1,000. So they claim to only have bought 600 more tons. But we know from Jim Rickards and other sources they bought well over 500 tons in just a month at one point in the last couple of years. And
there were reports that they bought more than the annual mine supply. So.
Yeah, that goes to the Shanghai Gold Exchange though. So that's probably private citizens. So we don't know if the Chinese government, the People's Bank of China, and other entities from the Chinese government are buying physical gold on the Shanghai Gold Exchange. We do know that private Chinese citizens are buying like crazy, like you said, with the mining supply. Right. A couple more points I would add though is China recently announced, and I heard this on an interview with Willem Middelkoop. When he was interviewed by Craig Hemke of TF Metals Report, China now announced that they're starting a $60 billion gold and resource fund that they want to start investing in mines, undervalued commodities and mines across the world. So that's one thing. And the other thing is we had David Jensen on, I think, about a month ago. And I think he said the worse the economy gets in China, I'm pretty sure it was the David Jensen interview. I don't remember exactly who said off the top of my head. I'm pretty sure David Jensen, though. But he said the worse the economy gets in China and the worse their currency looks, he said the more publicly announced gold reserves China will announce they have to strengthen their currency. So if the economy gets worse, their currency dives more, their banks are questioned by Wall Street, China, their stock market crashes even further. One of our guests had an interesting theory, and he expects China to announce their gold reserves faster. Now, obviously, I don't think any of these numbers are going to be the real number. I think every single country plays games with their gold reserves.
Oh, yeah, I agree. I mean, nobody knows how much the U.S. has in gold reserves.
Yeah, no audit. Yeah.
Yeah, no audit.
Yeah.
All right, so before we move on, any more points on that question?
No. So I think the evidence is clear, Mo, that the World Gold Council is not getting the numbers right. We know from Kuz Jansen and Bullion Star that the Shanghai Gold Exchange, where the Chinese citizens buy a lot of their gold, it's massive. We're seeing very strong demand for gold and also very strong demand for silver out of India, the lower the paper prices go. So I think the physical demand for the metal is strong, but there was a good interview, our listeners, if they haven't listened to already. It was from a Swiss gold refiner on the Physical Gold Fund website run by Alex Stanzik, who is a past guest on our podcast. And he said that, they have one of the five largest refineries in the world in Switzerland. And he said they're running their refinery 24/7, 365. They're having trouble sourcing large amounts of physical gold. It's all, old coins and bars. And he said he doesn't know why this doesn't affect the paper price. So, maybe China's involved in manipulating the paper price. Maybe they're doing what some of the people on Wall Street do, Mo, where they short the paper price, make money there on that trade, and then they buy metal with the profit.
That's a good theory right there, but who knows? We'll probably never find out. So going to the next question. Our next question from our audience is, why do people seek the safety of government debt in times of uncertainty? Good question.
What I would say, Mo, is I would just quote Rick Roll again. Rick Roll's the credit analyst, so we'll go to him for his view on bonds. And what I would say is, in times of uncertainty, when there's panics and bank runs and markets collapsing, people seek return of capital and not return on capital. So people tend to, even though, the U.S. is obviously mismanaging their finances, the U.S. government's mismanaging the economy, the central bank of the U.S. is mismanaging the economy, people just want their money back. They're not looking to take a lot of risk, or they don't view it as risky. They just want someone to nominally pay back the amount of capital that they put. And that's why cash and that's why treasury bonds do well during times of panic, at least for a short amount of time. The other thing is that, the mainstream financial media, the Keynesian economists, they have a lot of people believe that there's only deflation going on right now and that there's not any inflation at all. I hear this repeated all the time ad nauseum, and we'll get into that later in another question.
And also, people don't realize that people with 401ks, if they want to move their money to a safe place, the only place they could put it in is in a bond fund. They can't put it on a sideline. The money has to be invested somewhere.
Yep.
So a lot of them put it in a bond fund just to prevent losing any return on their investment.
Exactly. Exactly,
Yeah.
Mo. Exactly. Most of the savings that's left in the United States, and there's not a lot of savings left in the United States, unfortunately, is in people's 401ks and IRAs. So there's an estimate, I think, over $16 trillion left there. So maybe as part of a financial repression scheme in the future, going forward, you may see the U.S. government start to force American citizens to put 1 or 2% of all their assets into the treasury market for national security purposes. That's something we've talked about in the past. We haven't seen it yet, but we've seen the U.S. government start to put in different versions of capital controls to make it more and more difficult to get your money out of the United States.
Yeah, and there's a lot of banks out there that are required to invest in the treasury bond market as well. So
Exactly.
That's keeping
and the insurance
bond
companies,
market.
too. The insurance companies are forced to as well.
Yeah, exactly. So that's why the government bond market is still holding on barely. So that answered that question. So unless we have any other points, let's go to the next question. The next question is from one of our listeners, and her question, or his or her question is, my mother is selling her house and moving in with me next month. She will have about $250,000 that she will be depositing into her savings with Chase. Does it matter, or some bank riskier than others? Are there any better way of having a savings account? Someone told me that a savings account with a broker may be safer than a bank account. That's a good question. And to answer that question, yes, there are some banks out there that are riskier than others, especially the banks that got bailed out from the 2008 financial crisis, which we refer to as zombie banks, because they're pretty much being saved by the 0% interest of the Fed and being bailed out by the government, that even though they're alive, they're technically dead. And if you look at their balance sheet, nobody can interpret what's going on in their balance sheet because they have so much off balance sheet liabilities.
Yeah, the accounting for the banks, Mo, obviously since March of 2009, when the FASB, which is the Financial Accounting Standards Board, they changed the rules for the banks, and the banks didn't have to mark their assets down. They could mark their assets to whatever value they wanted. This gave the banks an unfair advantage. If any other business in any other industry, on an exchange, off an exchange, especially on an exchange, did this, right, the SEC would have busted them for fraud. But the banks were allowed to do this. And so it is very difficult to tell, because there's special purpose vehicles off balance sheet. There's a lot. The banks learned to copy a lot of stuff that Enron has done with their accounting in the past, and that's how they got away with their stuff for so long. There's a lot of off-balance sheet items on the bank balance sheet. There's really not a lot of independent bank rating agencies anymore. There was Egon Jones, and there was a few others. I think Weiss Research was one. But the three main rating agencies, Mo, Moody's, S&P, and Fitch, they're basically controlled by the government. They're handpicked. So they're part of this fascist oligopoly where they're government-protected oligopoly there. So basically, they have these large barriers of entry to be a rating agency. You have a couple independent rating agencies in the U.S. I think Egon Jones was one. They tried to downgrade U.S. debt, Mo, and then they were audited by the IRS, and they had the SEC going after them, I think, and they had all these government agencies going after them because they tried to get the U.S. government borrowing costs higher. There's zero hedge stories on this. And go back and look, Warren Buffett invested, I think, in Moody's because he thought it was basically a monopoly. And then, these were the guys that were stamping AAA ratings for highest quality on the mortgage-backed securities, on the subprime stuff, because, there's all these different subprime mortgages that are chopped up into these mortgage-backed securities and chopped up in bits, and the odds of all of them going default are very low. And so they were paid off, and there's a lot of research and news stories on this. But the regular rating agencies, I don't fully trust all of them, especially when it comes to rating government bonds and especially when it comes to rating the banks.
Now, this listener wants to know where he or she can put her mother's money. I think, honestly, he should try a local credit union and put the money there. I mean, you're not going to be insulated from any financial risk. If there's a financial crisis, I mean, the credit union is going to be affected no matter what. But at least they don't speculate with your money like the big banks do. And also, you should try to spread the money out to a couple of banks to get it under the $250,000 threshold, so you're insured by the FDIC.
Well,
so that's my advice.
Well,
even though the FDIC is kind of a bankrupt agency.
So the SIPC, which is for stocks, and the FDIC, which is for bank accounts, both of them are bankrupt. They don't have nearly enough funds to cover massive amounts of losses if multiple banks failed and multiple brokerages failed. There's not enough money in there. They both would have to go back to Congress to get more money. So there's an implicit guarantee from Congress, which also means the U.S. taxpayer is going to be on the hook for that. What I would say, and we talked about this, is holding that cash, $250,000, it's a good amount of cash. Holding that cash for many years, the government's still doing inflation policies, okay? Even though the mainstream media is talking about deflation, even though commodity prices have been down a lot, even though the emerging markets are worse than subprime at this point, there's still inflation in the economy, and we'll talk about this a little later. But I wouldn't hold $250,000 cash I wouldn't hold that just for a long periods of time. I wouldn't hold it for 10 years, Mo. In 10 years, the purchasing power of that $250,000 cash is not going to be a lot. So what I was trying to tell Misty there is her mother should think about maybe buying a couple rental properties from Jason Hartman or Kathy Fettke of Real Wealth Network, or Jason Hartman. There's other places she can do it. She can go to a local real estate agent, and she doesn't have to put all of her money into there. She can put a smaller amount. There's cheaper houses she can buy. Maybe she puts down $20,000 or $30,000 with a fixed rate mortgage, and maybe she gets cash flow, right, to pay off her bills, and she hires a residential property manager for her company, so she gets some rental property income in that aspect. And I think she should have it diversified into some assets. I don't know if she owns any precious metals out of the money, but the longer she holds all cash, the worse purchasing power that money is going to have. I'm thinking, Mo, 10, 15, 20 years out, that $250,000, it's not going to have the purchasing power of $250,000. So I'm not telling her to put, I'm not giving financial advice here. I'm just giving my opinion. But if that was my money, I would not hold all the cash for a very long period of time. I would obviously keep some cash in case there's cheaper asset prices, but I would definitely be looking to put some of the cash to work in some investments or asset classes that could put money back into my pocket. So, for example, Mo, there's ExxonMobil is a very cheap oil stock right now. It hasn't been cheaper since the year 2000 or the year 2007 or 2008. So there's a lot of bigger oil companies with pretty good sized dividends. Chevron, these are companies that probably will not go bankrupt. Maybe they will cut their dividend. I don't think they will completely cut their dividend. So there's good value if you know what you're doing in oil. You can buy an exchange traded fund for oil companies. There's Halliburton and Schlumberger, which are oil service companies. They don't produce the oil and natural gas. They don't do the refining. They mostly just drill off oil and gas wells, and then they give it to the producers to get the cash flow from that. So there's safer investment. There's also master limited partnerships of pipeline companies like Kinder Morgan, which used to be MLP, but now they're a C corporation. It's too complicated to go into on the podcast, but they pay a big dividend, and there's master limited partnerships like Enterprise Products Partners, Plains All American. These are considered safer midstream pipeline companies. Now, obviously, don't put all of your money into any one asset class. Don't put all of your money into any one company, but put some money into here and generate some cash flow. One of the strategies, Mo, to over the long term to become wealthy is to buy low and sell high. Is to learn how to identify cheap assets. And I think the oil price, we've had a really nasty correction the last 12 months or so. It's been absolutely nasty. Not all the oil companies are going to go bankrupt. We are seeing some acquisitions. We've seen Halliburton buy Baker Hughes, another large drilling company. We've seen Schlumberger buy Cameron International. So we've seen these larger companies, both of which I think are good investments. We've seen them go buy assets they think are cheap. Those are signs that the market is probably getting close to a bottom in the near future here, in my opinion. So I mean, there's deals to be had if you know what you're doing. And that's what we do with our consulting clients. We teach them through how to read financial statements, how to read balance sheets, income statement of cash flow. They want to learn to do it themselves, how to buy ETFs, how to look for different undervalued asset classes and things like that.
Well, there's all these options for her to think about, rental properties, buying dividend stocks, and et cetera. So she has a lot of options on her hand to save the purchasing power of her mother's savings right there. All right, so we got a couple more questions. This question is from Matthew Tillman Hart, and he wants to know, what do you think about BitShares? Do you think it can be a platform for the new age of finance? So BitShares hasn't even been launched yet. It's launching in about 11 or 10 days, and pretty much a stock exchange that is backed by a cryptocurrency, which is backed by an asset base. So it's a pretty interesting business model. I haven't fully looked into it yet, but maybe, Jason, you have more insight on that.
I haven't looked at it either. I know Patrick Byrne is coming out with something fairly similar. I forgot the name of his cryptocurrency exchange too, and I know Reggie Middleton was also working on one as well. So there's a bunch of these coming out. I thought his question was more about trying to raise capital on one of the cryptocurrency angel investing website platforms. So I thought he was an entrepreneur and he was looking to raise capital for his business. And I was just trying to tell him in my comments there that there's not massive amounts of capital available on the crypto angel investment websites, that he would have better odds if he's willing to give up equity and go to AngelList or go to Kickstarter or Indiegogo or one of those to start off with crowdfunding. So that's what I thought his question was.
No. He wanted our opinion of what we think about BitShares. Go to the website, check it out. It hasn't been launched yet. It'll be launched in about 10 days.
Okay, so it wouldn't be fair then. It wouldn't be fair for me to really give a comment on it because I haven't looked at it. I have spoken with Patrick Byrne about his company, but I'm planning on having Patrick Byrne back on, who is the CEO and founder of Overstock.com, big proponent of Bitcoin, and also investing in a Bitcoin cryptocurrency type of platform for stocks, bonds, and things like that.
Right.
I was planning on getting his opinion of is he worried that Wall Street is adopting Bitcoin and the blockchain so much. So we'll see what he says about that, because he's had a lot of experience, unfortunately, in his life with Wall Street corruption. As you know, he's been his firm has been audited by the SEC basically every year.
Right. Well, if we can try to get the CEO of BitShares on for a podcast to discuss the platform. We'll give that a try as well. So the last question, we had a few questions, but we're going to consolidate it into one question and answer it. There were a few questions about how can deflation be occurring when there's been so much currency added to the monetary system. Shouldn't this cause massive inflation due to purchasing power of money going down? The other question is, do you see more deflation ahead, or will there be QE4? So that's pretty much similar question there.
Yeah.
So we're gonna consolidate that and answer it in one answer.
Exactly, Mo. And so this goes back to the question that people get upset about, a name call, and Harry Dent screams at people, Peter Schiff screams at people. There's been, for certain gurus out there, name calling and things like that. So let's go to definitions of inflation and deflation. So everyone has different definitions. The Austrian School of Economics, which is the free market school of economics, they have a different definition of what's inflation and deflation than the regular mainstream Keynesian economics. So the definition, Mo, for inflation in the Austrian School of Economics is an increase in money and credit, which leads to higher prices. That's the higher prices are a symptom of the inflation that's already been created. They are not the cause. The higher prices are not the cause. They are the effect. And basically what that translates, what that means then for you, the consumer, people on Main Street, is that your purchasing power is going down because there's more money chasing the same or fewer goods and services. That's basically the most simple way I can say what the Austrian School of Economics definition of inflation is. Deflation would the Austrian School definition of deflation would basically be the exact opposite of what I just said for inflation. So for deflation, then, you would have a decrease in the money supply and credit available. You would have an increase in your purchasing power, and it would lead to lower prices. But the lower prices then would be a symptom of deflation and not the cause of deflation. They would be the effect of deflation. Now, let me read a quote from the great Austrian School economist Murray Rothbard, and this is from his 68-page biography on John Maynard Keynes called Keynes the Man, which you can go to the Mises.org website and download for free in ebook form. And he says, the general theory was not truly revolutionary at all, but merely old and oft refuted mercantilist and inflationist fallacies dressed up in shiny new garb, replete with newly constructed and largely incomprehensible jargon. And that is what obfuscates the inflation and deflation debate, Mo, because you have Austrians and Keynesians not using the same definition and arguing with each other constantly and name calling and things like that. Okay, so this is the most complicated question, probably one of the most complicated questions there is to answer. And let's talk about the world economy and where inflation and deflation fits into that right now. So basically, in previous questions that were asked by our listeners, they talked about, the debt supercycle, governments issuing all this debt, governments have issued massive amounts of new currency, governments have massively inflated asset prices. There's been a lot of inflation, Mo, that has gone into the asset markets globally. So that inflation, whether it's from the United States or the yen carry trade from Japan that hedge funds and investment banks have used, or China, or so many other different countries, a lot of this monetary inflation has gone into higher real estate prices, it's gone into higher bond prices, and it's gone into higher stock prices in the past. And it's been this way for a very long time. And pretty much every time we have a bust, right, a bubble bursting, the solution has been to create more inflation and pump the asset prices again or find a new bubble. And the thing is, when the asset prices fall in value, the people on the mainstream media call this deflation. But I wouldn't really call it deflation. According to the Austrian School of Economics definition, I would just say these were drastically overvalued asset prices due to inflation, and the value of these asset prices are falling. The Keynesian definition of deflation and inflation is just falling prices. So you have a situation here where the mainstream financial media, the academics, the Keynesian academics, the central bankers who are all basically Keynesian, they look at any falling prices, either falling consumer prices or falling asset prices, and they say, oh, that's deflating. Anything falling in price, it's deflating. Anything increasing in price is inflating. And so that's why a lot of the formulas, Mo, and there's a lot of reasons for this, but that's why a lot of the formulas for the consumer price index or CPI have been changed, because they want to hide this inflation, say it's deflation, so they can keep inflating the money supply and credit, and they can keep creating, more asset bubbles or more credit bubbles and things like that in the real economy.
I think a lot of people when they think of inflation, they think of what's happening in what happened in Zimbabwe and what's happening now in Venezuela and what happened in Argentina, where the value of their money was destroyed and they saw, $1 billion bills being printed and et cetera. So that's the mindset a lot of people have when they think about inflation. That when the Federal Reserve print all that money, they're expecting this kind of that kind of outcome.
Yeah. They expected hyperinflation or some type of either really bad stagflation or hyperinflation. There's different degrees of stagflation, and we're not in super high degree yet of stagflation. Although in the United States, according to the Chapwood Index, which we had Ed Batowski on, the inflation rate here in Washington D.C., where we live, it was 11.4% in 2011, 12.6% in 2012, 12.7% in 2013, 11.4% in 2014, and it's similar to that in other cities. So we have a situation here, Mo, where let me ask you a question, Mo. Are your bills going down? Have your bills gone down? Have you had horrible deflation in the last couple of years?
No. I mean, my gas bill is down due to the low oil price, but everything else has gone up. My grocery bill has gone up. My rent has gone up. Even my cell phone bill has gone up.
Yep.
So everything has gone up.
Yep. Healthcare bills up a lot. And This goes back to what the Austrian School of Economics says about inflation. And we're going to go beyond the definition of inflation. If you read the great Austrian School economists, the Rothbards, the Miseses, you will hear them say that inflation is 100% government created. So if the commodity prices are falling, but your property tax is going up, but your sales tax when you go out to eat, so there's an extra restaurant tax that's 1 or 2%, and this goes up 1 or 2% per year. Your property taxes are increasing. There's a new gasoline tax. These are all inflationary. They are all hurting your purchasing power, the value of your money, how much, what goods and services your dollars or whatever other currency you're using buys you. So we have a situation here, Mo, where the asset prices are starting to fall now, where commodity prices have fallen for a lot, and some of them, whether it's base metals, they're looking like they're going to fall more, although food prices have not fallen nearly as much as oil and gold and silver and base metals have, because, people are still eating. But, we have a situation where the mainstream media labels that as deflation, but look in the emerging markets. I mean, these economies are not doing well. So you look at economies like Brazil are not doing well at all, but their currencies are massively devalued. So the commodity currencies, so Australia, Canada, these currencies are at very low levels because a lot of their economy was leveraged to China. Their manufacturing base, at least, their mining and manufacturing, and then all their consumer industries were predicated off higher jobs that were around, service sector jobs built off, indirectly leveraged to China. And then you have the commodity, you have the emerging markets countries, the BRICS, the Brazils, the Indias, the Russias, Chinas. You have these guys where so much of their economy was based off commodity prices and producing commodities, and many of the other countries their business model, like I said, was to borrow a lot of cheap dollar-denominated debt, build a mine or build an oil well or a large amount of these things, and export goods to China. And for a while, this worked. Their currencies were strong. They could handle the debt load. They could keep, building new mines or oil wells and taking on new debt, and they could handle the debt burden. And now things are in reverse. And they have enormous dollar-denominated debt. Their currencies are falling. Ask the people in these developing world countries if they're getting any increased purchasing power from their currencies. So yes, their economies are not doing well, but you can still have deflation when your real economy is not doing well, because the Keynesians say that, inflation really mostly only occurs with wage growth, which is demand pull inflation according to the Keynesians. But Keynes also talked about cost push inflation, which is stagflation. So stagflation is a scenario where your real economy is not doing well, jobs are being lost, businesses are shutting down or going bankrupt and things like that, and your purchasing power is drastically declining. So we have a situation here, we have a bust now in the emerging markets where they've drastically taken on too much debt. They leverage their economies to China, to the Chinese economy and producing commodities. And even though their economy is not doing well, their purchasing power of their money is falling like a rock. So I don't really, some people would call that deflation, Mo, but I wouldn't call that deflation. And this goes back to the ends justify the means, and also reading Austrian School of Economics, and you know that the government cannot tax deflation. So I'm a historian, Mo. I don't know how much financial history you've read, but go back and look, and if anyone can show me a lot of proof, please show me proof when, since the Federal Reserve and these other powerful global central banks have been created, when have these central banks allowed real deflation where the savers, people on Main Street with cash, with purchasing power, with cash and savings, where their purchasing power increased every year? Now, maybe in a free market like the technology market more, they do have some free market forces left there where they can buy a better digital camera every year, every couple years, or a better computer, things like that. But across the board in pretty much every single industry, people are not able to buy more for their money. And there's a reason for that. And it's because the government and Keynesian economists and politicians hate deflation. Politicians do not get reelected during a deflation. They get blamed for a bad economy. So they'd rather buy votes and they'd rather promise goodies. So and the central bank just prints up the money so they can give out the money and they can get reelected and they can say how good the economy is and they can take credit for the economy. So we have a situation now, Mo, again, and this happens whenever there's an economic bust in the past, like you said, where people talk about how bad the deflation is, but the people on Main Street are really not seeing the benefits of this right now, although except for, lower gas prices, and maybe there's some bargains in asset prices like oil stocks and things like that. But the Austrian school definition that's not deflation, though.
Well, we did have the 1920 depression, or the Forgotten Depression. I think we had a brief period of deflation through those times when they
for 4 years, yes. For 4 years, from 1929 to 1933, the Federal Reserve was in place, and Milton Friedman wrote a long paper on this, and the Bank of England didn't want to send all of their gold, so the U.S. did some games with the Bank of England there, and they did a devaluation after 33. But there was deflation from 1929 to 1933, but you had a situation where Herbert Hoover, who had turned into a Keynesian, and his other Keynesian advisors, and then FDR, where they started, putting wage and price controls in place, and they didn't want falling wages and falling prices. So the effects of deflation to me are normally falling wages, falling prices, increased purchasing power from consumers so they can buy more with their money, their savings become more valuable. The Keynesians, the politicians, they don't like this. They normally will do whatever it takes. So in my opinion right now, you have mass amounts of inflation built up in the system, but the velocity of money is low. There's not a lot of lending and spending among the banking system in the U.S. and by a lot of consumers. So you do have credit increasing in the U.S., like Mo said, with subprime auto loan bubble. You have student loan debt bubble. You have the housing bubble attempted to be reinflated. And you have a lot of debt from corporate America to do mergers and acquisitions and share buybacks and basically things with assets, to buy assets. But a lot of that money supply and credit has not hit the real economy. It's not being lent and spent in the real economy. So that's why the velocity of money is there. But that doesn't mean there's not inflation according to the Austrian school. Now, for the Keynesians, they would say that is a sign of deflation because the velocity of money, the chart is down. But it just means that, in my opinion, there's stagflation still in the economy, but we have a situation where falling commodity prices, falling asset prices are going to be labeled as deflation. The bust in the emerging markets and commodity currency countries are going to be labeled as deflation, but the consumer, the person on Main Street mode, they're not going to see any real benefits of deflation for that long, if at all. Because I think what's going to happen is a lot of these government agencies in the United States, and you'll probably see this in other countries too, they're going to have a drop in their annual tax revenues, and they're going to come up with new taxes to increase on people to try to make up for the shortfalls. We've seen this, at the municipality and state level in the United States, where they expected a good economy to produce certain types of investment results for pension plans and things like that, and for other unfunded liabilities. And so they're raising taxes in areas like Chicago and things in a bad economy, which is, not a good it's not a good idea, Mo, to raise a lot of taxes in a bad economy. You're gonna make things even worse.
Right. Well, another time where we went to deflation is the 1920 depression, when Warren Harding was president, and he cut the budget and let the prices and wages fall, and the Federal Reserve didn't do anything, and we got out of the depression within 2 years. So I think that's another period where we had deflation since the Federal Reserve was created.
Exactly, and taxes. What I would outline though is there was more of an Austrian school type of policy there by the government. Government taxes, government spending was drastically cut. I think it was cut by 30%. Taxes were cut, and wages and prices were allowed to fall. So we had a full market clearing thing. It was extremely painful for 18 months, maybe for around 18 months, give or take. But everything was so cheap. The small business owner, the entrepreneur, they were able to go buy assets for cheap. They were able to hire new employees for cheap. There wasn't Obamacare and other rules and regulations and other taxes they had to worry about. They knew that they could take the risk there and get good assets and hire new talented employees and take risk and go build the economy. And we don't have that in place now. That system is no longer in place where that can happen. We have so many people fighting, politicians and unions and interest groups, trying to keep wages and prices higher at all costs. So I think we're in a situation here globally where, the central banks, they're going to try to figure out a way to prop up the asset prices still, and it may or may not work, but eventually then they're going to cause currency crises. So we might not see normal conventional type of inflation where wages are growing and things like that, but that doesn't mean because your wages are not growing, that doesn't mean there's not inflation. Look what's happening in Brazil. We have a friend, we won't name his name, but, he has a permanent residency in Brazil. He had a good amount of money in his bank account in Brazil, and, it's been in there for around a year, and there was a big devaluation. And, his purchasing power of his Brazilian reals, they were cut by over 30% in a short amount of time. So for those of you who are saying there's massive amounts of deflation all over the world, even if the economy is bad, governments can figure out a way to cheat you of your beneficial purchasing power gains during a deflation. And in general, Mo, too, I think the other perception I think we should add about deflation is that the Keynesians say how bad it is, but it's actually good for the economy. The Austrian School of Economics says deflation is the cure. It cancels out malinvestments, firms go bankrupt, capital gets moved around. You have all the resources, whether it's assets or employees, they change firms. This is good in the long term for the economy because you need the malinvestment, the bad investments. You need companies to go bankrupt, and that's not being allowed now. So, or not by the large corporations anyway. Maybe the guy on Main Street is being forced to do free market capitalism because there is no bailout. But the large banks, the larger corporations, those rules don't apply to them.
Right. Well, I think we beat that question to death regarding the inflation to deflation. So that's all the questions that we have from our listeners. If anybody else has any more questions, please feel free to email us on our website at www.wallstreetfrommainstreet.com, or you could leave a message under this YouTube video and we'll respond to you as soon as possible. Also, be sure to subscribe with us on YouTube and on iTunes, on Stitcher, and on our website. So we are everywhere. So if you want to listen to our podcast, you can go on YouTube, you can go on iTunes or Stitcher, or go to our website and download it yourself. And look out for more podcasts that's going to be coming out in the next couple of weeks. We have one with Rick Rule. We have one booked for Doug Casey and also Jerry Robinson. So look out for that. So thank you everybody for listening, and good night.